Why is everyone suddenly talking about the cryptocurrency market skyrocketing? This question resonates across investment forums and financial newsrooms. You see, there's a growing anticipation of a significant surge in the cryptocurrency market, and among the key indicators being observed by the investors and enthusiasts hinting at this potential financial upheaval is halving. Now, what's driving all these predictions, and what role does halving play in this unfolding scenario? Let's dive into the facts and trends that suggest the cryptocurrency market is on the cusp of a remarkable upswing. The cryptocurrency market currently presents a fascinating and dynamic landscape, marked by significant growth and evolving trends. Firstly, the market capitalization of cryptocurrencies has shown a remarkable recovery, reaching approximately $1.7 trillion as we entered 2024. This recovery represents a growing confidence among investors and a broader acceptance of digital currencies as a legitimate asset class. The resilience of major cryptocurrencies like Bitcoin and Ethereum, despite past volatility, underscores a maturing market that is increasingly viewed as a viable investment option alongside traditional assets. Bitcoin, the flagship cryptocurrency, continues to be a significant indicator of the market's health. Predictions for Bitcoin's price in 2024 vary, with estimates ranging from $25,000 to $75,000. This wide range reflects the inherent uncertainties in the market, influenced by factors such as regulatory developments, technological advancements, and macroeconomic trends. However, the underlying sentiment remains cautiously optimistic, with many experts expecting steady growth. A key development poised to impact the cryptocurrency market in 2024 is the anticipated launch of spot Bitcoin exchange-traded funds, ETFs. This move is expected to provide a significant boost to the market by offering investors a more accessible and regulated way to gain exposure to Bitcoin. The introduction of these ETFs is seen as a milestone in the crypto industry's journey toward mainstream acceptance and could attract a new wave of institutional and retail investors. Furthermore, the integration of cryptocurrencies with traditional finance, TradFi, is accelerating. This integration signifies a shift in perception, with the crypto industry increasingly being recognized as the future of finance. The entry of traditional financial institutions into the crypto space is a vote of confidence in the stability and potential of digital currencies. It also brings in a level of expertise and regulatory compliance that could further legitimize the market and attract more conservative investors. However, as we consider these developments, it's also essential to recognize the role of halving in shaping the cryptocurrency market, for we are approaching this event yet again. To understand halving, it's essential to start with the basics of how cryptocurrencies like Bitcoin operate. Bitcoin, the first and most well-known cryptocurrency, is created through a process called mining. Miners use powerful computers to solve complex mathematical problems, and in return, they are rewarded with bitcoins. This process not only creates new bitcoins, but also secures the network and processes transactions. Now, what does halving mean? The name itself gives it away. However, for those who still don't know, here it is in simple terms. Halving is an event that reduces the reward for mining new blocks in the blockchain by half. How often does this happen? Well, once approximately every 4 years, or after 210,000 blocks have been mined. The concept of halving is built into Bitcoin's protocol by its creator, Satoshi Nakamoto, as a way to control inflation and ensure a gradual distribution of Bitcoins over time. The idea is that by reducing the rate at which new Bitcoins are generated, the scarcity of the cryptocurrency increases, which could potentially lead to an increase in its value. The first Bitcoin having occurred in 2012, reducing the mining reward from 50 Bitcoins per block to 25. The second halving in 2016 saw the reward drop to 12.5 Bitcoins, and the third in 2020 brought it down to 6.25 Bitcoins. So there's no denying that halving does affect miners. You see, since crypto mining is an energy-intensive process requiring significant investment in hardware and electricity, The reduction in rewards means that miners' profits are also cut in half. This can lead to a shakeout in the mining industry, where only the most efficient and well-capitalized miners can continue operating. As a result, halving can impact the decentralization of the mining process, a fundamental principle in the cryptocurrency world. This decrease in supply, assuming steady or increasing demand, can lead to a rise in Bitcoin's price. The economic principle of supply and demand plays a crucial role here. When the supply of an asset decreases while demand remains constant or increases, the price of that asset tends to rise. For instance, after the first Bitcoin halving in 2012, the price of Bitcoin saw a significant increase. Before the halving, Bitcoin was trading at around $11, and a year later, it reached highs of around $1,100. Similarly, the second halving in 2016 saw Bitcoin's price jump from around $650 to approximately $2,500 in 2017. The third halving in 2020 also followed this trend, with Bitcoin's price rising from around $8,000 to an all-time high of nearly $64,000 in April 2021. However, it's important to understand that the impact of having Bitcoin's price is not immediate and can be influenced by various external factors. These include global economic conditions, regulatory changes, technological advancements, and overall market sentiment. For instance, the 2020 halving occurred during a period of global economic uncertainty due to the COVID-19 pandemic, which also played a role in influencing Bitcoin's price. The anticipation of halving events also contributes to market dynamics. As a halving approach, it often creates a sense of excitement and speculation among investors, leading to increased buying activity. This speculative run-up can sometimes lead to volatile market conditions, with prices fluctuating significantly in the period leading up to and following the halving. Where are we headed now? Regarding the next halving, set to take place on April 23, 2024, and reduce the block reward to 3.125 BTC, one of the most striking predictions comes from analysts at Blockware Solutions, who suggest that the Bitcoin's price could be propelled to an astounding $400,000. This prediction is based on a combination of factors, including the reduced rate of new Bitcoin creation and increased institutional adoption. Another prediction by a global investment fund anticipates Bitcoin reaching $100,000 post-halving. This forecast considers the twin turbo boost from the halving event itself, and again, the potential approval of a spot ETF. CoinCodex offers a more conservative estimate, forecasting Bitcoin to reach approximately $49,300 by April 2024, with a potential rally to around $84,100 after the halving. Plan B, a well-known figure in the cryptocurrency analysis sphere, has a series of predictions extending beyond the 2024 halving. Plan B expects Bitcoin to reach $55,000 at the time of the halving, followed by a rise to $100,000 in 2024 and an impressive $532,000 in 2025. These predictions are based on Plan B's stock-to-flow model, which relates Bitcoin's price to its scarcity. A historical analysis of Bitcoin's price post-halving also provides insights into potential future trends. CoinCodex, for instance, sees a Bitcoin price peak above $170,000 in August 2025, followed by a retracement to levels near $95,000. However, investors and market observers should approach these predictions with caution, considering the inherent uncertainties and complexities of the cryptocurrency market. The halving event is undoubtedly a key milestone in Bitcoin's life cycle, but its impact is shaped by a complex interplay of factors that extend beyond simple supply and demand dynamics.